Hello, everyone, and welcome to today's presentation. I'm excited to have you here as we explore the rules of debit and credit from the American approach, along with some insights into modern accounting classifications. On this first slide, I want to give you a quick overview of what we'll cover today. We'll start by understanding the fundamental rules that govern debits and credits, then look at how these principles fit into modern accounting classifications. So, let's dive in and get started. Now, let's talk about what we call the American approach, or sometimes the modern approach. This method is quite fundamental in understanding how we organize and analyze financial information. Essentially, it divides accounts into 5 key categories, which help us keep everything clear and structured. First, we have assets, which are resources owned by the business, things like cash, inventory, or equipment. Then, liabilities are what the company owes to others, debts or obligations. Next, we have capital, which represents the owner's interest or equity in the business. Moving on, revenue accounts track the income generated from sales or services, while expenses record the costs incurred in running the business. Recognizing these categories is crucial because it provides a systematic way to classify and interpret financial data, making it easier to analyze the company's financial health. This approach ties into the overall theme of financial clarity and consistency, helping us make informed decisions based on well-organized information. Now, let's take a closer look at the classification of accounts, which is fundamental to understanding how a business's financial information is organized. First up are assets. These are what the business owns, like cash, inventory, equipment, or property. Think of assets as the resources the business uses to operate and grow. Next, we have liabilities. These are what the business owes to others, such as loans, accounts payable, or other debts. Essentially, liabilities represent the obligations that need to be settled over time. Then there's capital, which reflects the owner's claim on the business. It's what the owner has invested, plus any retained earnings, and it shows the net worth of the business at a given point in time. Moving on, revenue is the income generated from the core operations of the business, like sales of products or services. It's what brings money in and is crucial for assessing the business's profitability. Finally, expenses are the costs involved in running the business, like salaries, rent, utilities, and supplies. These are the outflows that reduce profit. Together, these classifications help us organize financial information systematically, making it easier to analyze performance and make informed decisions. Understanding how these accounts fit into the bigger picture is key to grasping how a business's financial health is assessed. Now, let's take a closer look at the rules of debit and credit, which are fundamental to understanding how transactions are recorded in accounting. When it comes to assets, increasing an asset is recorded on the debit side, while decreasing it is recorded on the credit side. Think of assets as resources the company owns. If you acquire more assets, you debit, and if you dispose of some, you credit. Next, liabilities work in the opposite way. When liabilities increase, we record a credit, and when they decrease, we debit. So, liabilities represent what the company owes, and their increase signifies a new obligation, which is credited. Similarly, for capital, which reflects the owner's equity, an increase is credited, meaning the owner's stake grows, and a decrease is debited. This helps us keep track of how the owner's investment in the business changes over time. Moving on to revenue, which is the income earned by the business. When revenue increases, we credit it. This shows that the business has earned more, boosting its equity. Conversely, a decrease in revenue is debited. Expenses are a bit different. They increase on the debit side and decrease on the credit. When the business incurs expenses, we debit, reflecting a consumption of resources, which ultimately reduces profit and equity. By understanding these rules, we can accurately record every financial transaction, ensuring our books reflect the true state of the business. These principles are the backbone of double-entry bookkeeping and tie directly into the overall theme of maintaining balanced and reliable financial records. Now, let's look at an example of a cash receipt transaction. Imagine your business sells a product or service and, in return, receives cash from the customer. This is a common and straightforward transaction. When this happens, we record it in the accounting system by increasing our cash asset, which is represented by a debit. Think of it as adding to what we already have. Simultaneously, we recognize the revenue earned from the sale, which increases our sales or revenue account. This is recorded as a credit, indicating we've earned income. So in this case, the key points are that receiving cash boosts our assets, and it also reflects income we've earned. These two entries, debit to cash and credit to sales, keep our books balanced and accurately show the transaction's impact. This example ties into the overall theme of understanding how everyday transactions affect our financial statements, helping us maintain clear and accurate records. All right, let's dive into example 2, which is about taking a loan. So, imagine a business deciding to borrow money from a bank. When this happens, we record it as a transaction in the accounting books. Essentially, we're increasing the company's assets because cash comes into the business, so we make a debit entry to cash. Think of it as the business now holding more cash, which is an asset. On the other side, since the business owes this money back to the bank, we record a liability. That's why we credit the bank loan account, increasing our liabilities. This transaction reflects a fundamental principle in accounting. For every debit, there must be a corresponding credit. This example is a great way to see how borrowing funds impacts both the assets and liabilities on the balance sheet. It's also a clear illustration of the double entry system, where every financial event affects at least two accounts. Overall, understanding this helps us see how borrowing from a bank is not just about getting cash. It also creates an obligation that must be managed over time. This ties back to the bigger picture of how financial transactions shape a company's financial position. Now let's look at an example of how a business records rent paid. When the company pays its rent, this transaction impacts two accounts. First, we record an increase in rent expense because paying rent is considered an expense that reduces the company's profit. So we debit rent expense to reflect this increase. Secondly, since the payment is made in cash, we need to show a decrease in our cash asset. Therefore, we credit cash to indicate that cash has gone out of the business. This example highlights two key concepts: the dual effect of every transaction on the accounting equation, and how expenses decrease assets. Understanding this flow helps us see how transactions impact the financial statements. Remember, every payment reduces an asset, like cash, and increases an expense account, which ultimately impacts net income. This is fundamental to maintaining accurate and balanced financial records, aligning with the overall goal of clear and consistent accounting. Now, let's look at an example of how capital introduced by the owner affects our accounts. When the owner invests additional capital into the business, we record it as an increase in both cash and capital. So, we debit cash, which is an asset, to show that cash has gone up. At the same time, we credit the capital account, reflecting that the owner's equity in the business has increased. This transaction highlights the dual aspect of accounting. Every increase in one account has a corresponding increase in another. It's a simple yet fundamental concept that underscores how owner contributions directly boost the company's resources and equity. Remember, these entries keep our books balanced and accurately reflect the business's financial position. This example ties back to our overall theme of understanding how different transactions impact our financial statements and the importance of recording them correctly. Let's wrap things up with a quick summary. The American approach to accounting primarily uses what we call the modern classification system. This means that each type of account, whether it's assets, liabilities, equity, revenues, or expenses, has its own specific rules for debits and credits. These rules are essential because they guide us in recording transactions correctly. By following these guidelines, we can ensure that our bookkeeping stays accurate and reliable. Overall, understanding these classifications and rules helps maintain the integrity of financial records, which is fundamental for proper financial management and reporting.